Hi, it's Dwyer. Wealthspinning.blogspot.com, a free investment-oriented site. Also, gamblersadvisory.com, a sports betting advisory site that's also free. Let's talk about money, investor to investor. We're just sharing thoughts. But first, remember, the opinion you should follow should be your own. Just consider this video to be a second opinion from a complete stranger online. Today is June the 10th, 2022. Now, to sum up where we are in the world, in my opinion, and I'm just giving you my take, and let's make it very conceptually easy. It's too easy to get lost in the weeds. The view I believe in is a macro view. So simply put, right now, in the world, the reason we're in financial crisis, and that's where we are, is because there is a lot of debt that won't be repaid. Right? Not just sovereign debt, not just government debt, but also commercial debt. Also, debt with friends. Understand, creditors, the people who lend money, have loan assets that they won't be able to collect. Pension holders in states such as Illinois, New Jersey, and Kentucky. Right? Now, I'm being charitable here. There are a lot more states than that. Have debts owed to them that they won't be able to fully collect. In other words, people's perceptions overstate the actual value of the assets that they have. We're in a bear market. So you're going to have what's called debt destruction. Now, as debt is wealth for creditors, you're going to have wealth destruction. Let's put it another way. Some entity or some person owes you $100. So you think, okay, let me add up the assets I have. You're going to say, well, I'm owed $100. Let me add that to the balance sheet. Well, if they're insolvent, if they can't pay you the $100, that's bad news for them, but it's also bad news for you, because you now have a $100 account receivable that's worth zero. That's going to go on throughout the economy. Right? So let's be clear here. Prior debt, based on different market prices, is plunging in value. If you have a treasury that pays you 2%, that's worth a hell of a lot less than a current 10-year, which is paying over 3%. Right? Just understand, you're the guy in the room making less on the debt you got than the guy who just bought a 10-year treasury at current prices. Right? The price of debt was too low before. It did not fully account for all of the risk involved. Right? It did not account for the debtors, the other side of the debt market, right? You have the creditors, the people owed the money. Then you have the debtors. It didn't account for the level of insolvency, the level of inability to pay that debtors have. right? A lot of debtors right now are getting their cars repossessed, can't pay their bills, are behind on their rents, are behind on their mortgages. What does that mean? That means that the other side of the play, the creditor side of the play, and this is how you should think about it, debtors and creditors, right? Markets have different sides. So the people who were leasing the car now have to, to a debtor, now realize that the debtor can't pay the lease. They have to go get the car back, right? The landlord who's leasing the apartment to a debtor tenant now realizes the debtor can't pay the rent. And of course, the home lender who has given a mortgage to, we'll call them a home owner. That word owner is loose here in this context, right? Because the owner actually has the house pursuant to a mortgage. We're finding out that a lot of homeowners can't pay the mortgages. And so the commercial lenders might have to foreclose on the house. So folks, as a society, we're now realizing that there's less wealth to go around. That a lot of people who owe money can't pay what they owe. If you've ever been a creditor in a bankruptcy case, you know what I'm talking about. Someone who owes you money declares for bankruptcy. You show up to the meeting of creditors only to hear the bankruptcy trustee say, hey, there's no more money to pay you. Right? That debt that you were supposed to collect, you won't be able to. The debtor legally has gotten out of that obligation. Right? Folks, this has a cascading effect because our economy is interconnected. So someone owes you $100. You might then say, I have $100 in receivables. Let me go out and spend it. Right? Understand what happens now. If you were going to spend that $100 at a restaurant, if you find out that you're not going to get paid the $100, then you won't go to the restaurant. The restaurant doesn't get your money. They can't hire new people. They don't have the profits that they would have gotten had you gone to the restaurant, had you received the $100 owed you and then spent it at the neighborhood restaurant. So, of course, monetary velocity is plunging. There are fewer dollars in the neighborhood. Fewer people are getting hired in the neighborhood. One of the challenges we have now is when you're coming out of an easy credit era where people are making a lot of loans to debtors and everyone is pretending that all of these loans are going to be repaid. Right? When you come out of that to an era where the 10-year Treasury has jumped from 2% to now 3%. The Fed is hiking rates. Debt now is becoming scarcer and more expensive. When you come into this era, you find out how many debtors can't pay their debts. You find out how many creditors have loans that they're supposed to be able to collect that they can't. So, just a few thoughts. I want people to understand that the bond market, right? We call it bonds, folks. It's debt, right? Just understand that. The bond market is much bigger than the stock market. Let's get past the illusion. As you're watching CNBC, and they're focused on the stock market, and they're talking about some stock going up, some stock going down, and it looks like a sport. Understand that the real game in town is the bond market. The bond market tells you the state of the economy. Now, let me just point out that debt has been repriced. People are now realizing that the risk is great, that a lot of the debt won't be repaid. So, what does that mean? That means that all the previously issued debt, right, is dropping in value. If you buy loans, and you know this if you're in finance, why would I buy an old loan where the debtor is paying a lower rate of interest than buying a new loan where the debtor is paying a higher rate of interest? So the people holding old bonds are getting crushed. You need to pay an eye on that market. It's huge, right? The people holding old debt are losing a lot of wealth. So for an investor, just in the short term, right? The moves you should be making right now is to, well, I'll just tell you what I'm doing. I'm trying to shift money into unencumbered, that means debt-free, hard assets, right? Some people call it a relic. I call it a necessity. You need to consider investing in gold. You need to consider investing in silver. Now, here's where the video gets controversial. In the short term, Bitcoin is tracking the stock market. Bitcoin's new. I believe a lot of investors are confused. They don't understand that Bitcoin is debt-free. They don't understand that Bitcoin is limited supply, even more limited than gold. Bitcoin should be a hedge on the market, right? Bitcoin shouldn't be tracking the stock market. It should be a hedge on the market. So right now, incredibly, and in the short term, you're going to have mispricings. Incredibly, gold, silver, and Bitcoin are all undervalued right now. Right? Understand, folks, the government can't just print gold, silver, or Bitcoin. Right? No one can just go out there and start randomly creating gold, silver, and Bitcoin. The demand can't immediately impact the supply. Sure, gold exploration can be increased. Silver exploration can be increased. But neither can be produced by man. They're limited supply. That's where you want to be. What's dangerous right now are debt-financed markets. So, you're thinking about buying a new home. Let's say you have the cash to do it. Right? Let's say you're one of the rare few who have the cash to do it. Right? I want you to look around the block of the home you're thinking of buying. Your neighbors. How did they get their homes? Did they buy it debt-free, free and clear? Or did they have to go through debt markets to purchase their homes? Are you in an area where you feel the mortgages are fixed? In other words, however the price of debt changes, the homeowner has a fixed rate of interest for 30 years. Or is it adjustable? Which means that as the price of debt increases, and folks, it's been increasing. Just look at the 10-year. Right? As the price of debt increases, are your neighbors going to have to pay more? Understand, you don't have to be exposed to the debt market directly to be exposed to the debt market indirectly. Because even if you bought your home free and clear, if everyone else on your block has an adjustable rate mortgage, and if their prices start going up, and they start bailing on their homes, allowing the house to be foreclosed on, or selling their house to get from under the debt, the prices of homes, including your home, might drop in value. Right? So one of the first things anyone should do in processing all the financial information out there is they should ask themselves, what is the price of debt? Have your own barometer. As I make this video, the U.S. 10-year Treasury is going off at 3.12%. Right? 3.12%. That's what they're paying creditors for holding the U.S. 10-year Treasury. What I want people to do is to look at the U.S. 10-year Treasury chart. You're going to find out that the interest rates on treasuries has been increasing. Right? When interest rates increase, you have a lot of people, debtors, who can no longer afford the adjustable rate mortgage they have. Right? You have a lot of prospective debtors, people saying, hey, I might want to buy that house, who then find out that the financing on the house is much more expensive than it was 18 months ago. Right? Most of the people finance their home purchases. If the financing is more expensive, then you're paying more. Right? So in